Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Jun-sok, professor of economics at the Catholic University of Korea. Professor Yang, good afternoon. Thank you for making time today.
Happy to be here.
Well, let's start with Wall Street, where last week there were some ups and downs. No let up in the war in Ukraine. Some moves to do something about energy prices. Expectations for more aggressive moves by the Fed. All of that, people watching. What's the story in the global markets, and what are you watching this week?
Okay, well, while the Friday's results were mixed, S&P rose by 0.5%. Dow by 0.4%, and NASDAQ fell by 0.2%. If you look at it for the entire week, the U.S. markets actually had a fairly good week. Dow went up by 0.3% over the week, S&P by 0.5%, and NASDAQ up a whole 2%. It was the largest two-week gain since late 2020, and S&P has now erased the losses that it took after the Russian invasion. This is despite the concerns about rising interest rates and rising inflation. The 10-year bond rates have risen to 2.5%, but the job market in the United States remains strong. We had the lowest new jobless claims since September 1969, and for the continuous jobless claims, it was the lowest since January 1970, and March. This was a week. These two were weekly reports. The March monthly report is expected to show strength as well. The U.S. company earnings remain strong, and this is the good performance by the U.S. market was partially due to oil and grain prices falling in the middle of the week, even though it did start climbing again before the end of the week. Even though the U.S. job market and growth remain relatively on track and strong, inflation is pulling down consumer sentiment. University of Michigan consumer sentiment was recorded to be 59.4. That's a nearly 11-year low, and the Fed is now giving more signals that it may perhaps increase the interest rate by 0.5 percentage points the next time they're going to raise the rates. This mixture of good and bad news makes the market more volatile, so we'll probably be stuck with volatile markets for the near future. For the European stocks, well, U.S. President Joe Biden is in Europe, and European countries signed a deal with the United States to increase U.S. shipments of natural gas to Europe to wean off Russian energy. And this may have given especially Germany a bit of a boost. On Friday, DAX index rose by 0.22%, FTSE by 0.21%, but French CAC remained more or less even at minus 0.03%. For Asia, even though the oil prices fell today, the markets do not seem to be taking advantage of that all that much. The Nikkei fell by 0.42%, Shanghai by minus 0.13%, but Hang Seng rose by 1.3%.
Well, here in Korea, the KOSPI started out a fair bit lower this morning, but had recovered most of that by the end of the session. The biggest names were a bit of a mix, many of them flat for the day. Foreign investors started the week as net sellers. Tell us about the domestic market, Professor.
Well, the Korean market seemed to be holding more or less steady, so there wasn't really that much that really changed, especially for the KOSPI index. What interesting news there was had to do with Japanese yen. Because of the potential for rising interest rates, U.S. dollar has been gaining strength, and Korean won and Japanese yen have both been weakening against the U.S. dollar. But today, Japanese yen lost its value a lot more than the Korean won. Korean won against the Japanese yen recorded 996.55. That's the strongest level for Korean won since December 2018. KOSPI, again, it was mostly unchanged. It was down, but only by 0.02%. It ended today at 2,729.39. It seems that the market is bracing for rate increases in the United States. Year to date, it's down by 8.7%. Individuals and institutions bought, foreigners sold. KOSDAQ, it was down 0.8%. It ended today at 927.21. Year to date, it's down 10.7%. Individuals bought, institutions and foreigners sold.
Well, Professor, looking at Treasury yields right now, there would seem to be some mixed signals. The 2-year and the 10-year getting close to inverting, which could indicate recession, while the spread on 3-month and 10-year notes getting wider, which would go along with the idea that the U.S. economy is recovering. What does the yield curve tell us right now?
Okay, well, first a little explanation about what the inversion is. It's that it's when the short-term interest rate, you usually look at 2-year bond yields, but some people prefer 3-month bond yields. That short-term rate rising above the long-term rates, usually 10-year bond yields. It's basically assuming that interest rate will rise higher in the short run than in the long run. And the concern is that whenever U.S. had an inverted yield curve, it had a recession, and that's been one of the most sure indicators of recession over the past 60 years. The interpretation is that the Fed will go too far in trying to protect against the recession, so it will raise the rates too much in the short term and then lower it. Now, the Fed has signaled 7 rate increases this year, including possibly 0.5% point increases due to the high inflation. But inflation is expected to fall back to 2% range next year, not just by the Fed, but also by consumers, financial analysts. And if you compare the U.S. Inflation protected bonds against inflation non-protected bonds, it does seem to indicate that the inflation will go back to 2% level after a year or two. So inversion is a concern that either recession will start up or the interest rate will rise too quickly so that it will induce a recession. But there's a counter-analysis which I find personally more convincing, which is that right now the U.S. long-term rates are heavily distorted because of the quantitative easing effect. So the long-term interest rate is lower than where it should be, and that is making it look like the market is having an inversion. But additional concern is that because inversion has been used as a useful tool since for the last few decades, perhaps the markets will take this inversion too seriously, and the recession and the problems in the stock market will become a self-fulfilling prediction, even though it was predicted because of distorted long-term rates.
Well, it's a very interesting contention you make, Professor. We'll have to keep an eye on that. And finally, the Bank of Korea this week will have some data on consumption trends in Korea, also some industry data from Statistics Korea. We saw, of course, consumption and production both down earlier this year, so it'll be interesting to see what the current wave of the coronavirus will have done to those numbers in February. What's on your radar this week, Professor?
Well, on Tuesday, we have the consumer sentiment numbers. Thursday, the business sentiment numbers. Wednesday, personally, export and import price index will be interesting because it'll show whether the increases in imports and exports that we have are due more to prices or volume. My personal feeling is that it's due to more to price increases than volume, and that will lead to a more trade deficits for the near future. Thursday, we have February industrial trend report showing consumption, investment, and production. And for the foreign statistics, we have U.S. job opening and labor turnover over so-called JOLT report. That'll give us an idea on how strong the U.S. labor market is. Right now, the unemployment figures do show that the U.S. labor market is very strong. And then for inflation warriors, we have U.S. personal consumption expenditure price index coming out on Thursday, which is the primary price index that the Fed uses to determine whether the U.S. market has high inflation or not. And on Friday, U.S. will have their monthly unemployment report.
Got it. All right, Professor, we'll have to leave it there for today. Thank you, as always, for sharing your insights with us. We appreciate it.
Thank you.